Hey everybody, it's Chris Small, the owner of CMS Law Firm. Today I want to jump into part 2 of my charitable remainder trust discussion. All right, I was supposed to be here yesterday, but I didn't have my suit on. So today we're suited up and we look like a lawyer. Today we might even sound like a lawyer. Before I get into the details though, I want to remind you, if you have any questions related to estate planning or probate and you want to talk with us about it, you can do so for free by going to cmslawfirm.com. Okay, so yesterday, a couple days ago in part 1 of the charitable remainder trust discussion, I think I just sort of did an overview of charitable trusts generally, charitable giving generally. Today I wanted to get into the nitty-gritty, into the details a little bit about how to create specifically today a charitable remainder annuity trust. Before we get into those details, let me give you the quick and dirty background one more time. So a charitable remainder trust generally is an irrevocable trust. What it allows you to do is basically take some asset that you have, put it into this trust, and what happens is once it gets into the trust, often it will be sold or it will be turned into some sort of cash. And then the income from that trust is distributed out to someone over time, and then the remaining assets in the trust are given to charity. Does that make sense? Hopefully it does. One of the cool elements of a charitable remainder trust, there are really two cool elements. There are many more than this, but from a tax perspective, you don't have to pay capital gains tax when the assets inside of the trust are sold because of the charitable element. Okay. Number 2, the person donating or giving the asset into the trust can also take a current income tax deduction for the charitable amount that they are going to be giving via the trust. All right. Hopefully that made sense. If it didn't, go back and watch part 1. In the future, go and watch parts 3 through whatever's left, and you will be a charitable remainder or a charitable trust, remainder trust expert by the time you're done. All right. Today, though, I wanted to talk about the elements just generally of a charitable remainder annuity trust. This type of trust, the difference between this annuity trust and a unitrust is basically the annuity trust is going to give you a very specific amount of money every year, a set amount of money, let's say $50K, all right? With a unitrust, which I'll go through the elements of a unitrust as well, in a different video, you're getting a certain percentage of the trust as opposed to a certain amount of the trust, okay? All right, with that being said, there are specific rules that are required to create a trust like this. The IRS is the entity that creates these rules, and because they are the IRS, and because we're talking about taxes, they like to try to make them as what I like to call simply complex as possible. If you ever get into the IRS code, what you'll find is you'll read some regulations and there'll be an exception, and the exception will point you to a different rule. And when you go read that rule, there'll be another exception within that rule. So you end up down this rabbit hole of like rules and exceptions and rules. It's wonderful. But that's why you pay someone like me, like us, the big bucks to help you figure this out. All right. So here are the requirements of a charitable remainder annuity trust. Requirement number 1. When you create this trust, there must be a fixed amount that is paid out to a non-charitable entity. Typically, if I was the person that was creating the trust, the grantor, I would put an asset in and then I would be the one that gets paid back. If you don't want to be that person, you don't have to be, but typically that's going to be how it goes, okay? The annuity, so the payment amount that's paid out must be not less than 5% or more than 50% of the initial fair market value of the trust, okay? And this is not the yearly annuity, this is the total annuity. When we'll get to that, maybe when we get in the weeds. We'll get in the weeds next time, I think, a little bit, because we'll talk about how to calculate the charitable deduction presently by the amount of the assets left in the trust when you're done, okay? I know, we're getting complicated. It's okay. Stick with me. You're going to figure this out. The payments, the annuity payments, back to the grantor must be paid annually. So you have to get paid out of the trust every year. The trust must be irrevocable. This is important. What that means is when the trust is created, when the assets are transferred into the trust, the person that's creating the trust typically loses all abilities to change the trust, to move assets out of the trust. That's why it's called an irrevocable trust, which means you cannot revoke it. There are some exceptions to that rule. Namely, you sometimes can be allowed to change the charity that you want the eventual payout to go to. There are some other things that you can do, but don't worry about that for now. Let's see. The trust, when you create it, it must benefit someone that's actually alive. Okay, so the payout from the trust, the annuity, must go to someone that's actually alive. And the payout cannot last more than 20 years. Okay, so the charity is going to be getting paid within 20 years. What that amount of time is going to depend on who the beneficiary is, how old they are, and what you want to do. Okay, oftentimes, if you are of a more increased age, if you're older, and you give it to someone that's also older, sometimes you may just give it to them for life, or 20 years, like whichever is shorter, and they die within 20 years, and that's over. Okay. Let's see. The next requirement is that the entire remainder must go to charity. So at the end of the term of the trust, after the last annuity payment has been paid, the rest is going to go to charity. This is important because if you have a trust like this and the money that's invested in the trust appreciates greatly, all of that appreciation is going to go to charity. Okay, it's not paid out to the grantor or to the beneficiary. It just stays in the trust. So, for example, if you have $1 million asset, you put the $1 million asset into the trust, and you're going to pay out $50,000 per year, so 5%. So you've made that 5% threshold, and you're going to pay it out for 20 years. Whoever's in charge of investing that money, invest that $1 million, and it grows significantly. And so even though you've been paying out $50,000 a year for 20 years, when you're done, the principal in there is $10 million. That $10 million is going to go to whatever charity that you've named. That makes sense? Whatever's left goes to charity. No exceptions on that. And then the last requirement is that the remainder value at the time that you create the trust must be calculated to be at least 10% of the initial fair market value of the asset. Okay, so if you, to continue with our example, if you take $1 million asset and you, the structured payout, the defined payout to the charity at the end must be at least $100,000, 10% of $1 million. And there are tables and there are ways to do that, which I'm going to talk about in a different video, but those are sort of the requirements, the basic requirements of a charitable remainder trust. Have I blown your mind yet? If I have not, good. If I have, that's okay. Watch this video again, watch the other video, go Google charitable remainder trust. There's lots of information out there on it. No one's going to break it down quite like I do because I'm just weird, but that's how we do it. So charitable remainder trust part 2, the requirements for a charitable remainder annuity trust, also called a Crat. Okay, if you want to sound fancy, call it a Crat. All right, that's it. As usual, thanks for getting this far. Appreciate you. If you need help with this or anything else related to estate planning or probate, and you want to talk with us, you can go to cmslawfirm.com. Set up a time to talk with us over the phone for free. cmslawfirm.com. All right, that's it. I'm Christopher Small, as always. You know who I am. Thank you for your time. Thank you for your attention. I appreciate you, and I'll talk to you again soon. See ya.